Today, the Evergrande factor and beyond. Hello again, it's Martin North from Digital Finance Analytics. Welcome to latest posts covering finance and prop news with a distinctively Australian flavour. So the news from China and from China Evergrande continues to grind on. And in fact, China Evergrande Group's property sales plummeted in 2021 for the first time in at least a decade, as the giant developer slipped into default and buyer confidence faded. Evergrande, China's second biggest developer by sales in 2020, is the largest Chinese real estate developer by issuance of offshore US-denominated debt, which stood at $19 billion last year. A filing on Tuesday showed that the company's contracted sales of properties totaled 443 billion yuan, or about $69.22 billion last year, and that's down 38.7% from the 723 billion yuan in contracted sales reported in 2020. It met about 60% of a 750 billion yuan target set at the start of the year. The preliminary results suggest that sales at the world's most indebted developer has been almost frozen since October, when its liquidity woes intensified. Annual sales were almost the same then, with 442 billion yuan sold year to date as of October 20. Evergrande's property sales had been on a steady decline since the middle of the year, after news of stalled construction startled home buyers and spurred protests. The company is rushing to deliver on its building obligations, saying last week that it resumed construction on 92% of its housing projects, compared with just about 50% at the beginning of September. Shares of the developer, which resumed trading after a one-day halt, rose 1.26% on Tuesday in Hong Kong, but traders struggled to pin down a major reason for the gains other than short covering. Evergrande shares ended up 1.3% after a session that saw the stock rise as much as 10% and drop 2.5%. In fact, shares have plunged more than 88% over the last 250 trading days. Monday's suspension followed reports that Evergrande had been ordered to demolish apartment blocks in a development in Hainan province and had dragged down shares of other Chinese builders. Evergrande said that it received an administrative penalty notice issued by the Dahu Comprehensive Administrative Law Enforcement Bureau regarding 39 buildings on Ocean Flower Island, according to a Hong Kong Stock Exchange filing. It said it would actively communicate with the authority to resolve the issue properly. The order adds to troubles facing the property giant, which has been straining under more than $300 billion of liabilities, a crash crunch in recent months, and the decline in new home sales. S&P Global Ratings and Fitch Ratings labelled Evergrande a defaulter in December following coupon payment failures on dollar notes. The company will continue to actively maintain communication with its creditors, it said in the filing. S&P Global Ratings warned in November that an Evergrande default is highly likely, since the company is no longer able to sell new homes. Like other Chinese real estate developers, Evergrande's business model relies heavily on sales of apartments to customers before the units are completed. That sounds like a Ponzi to me. Evergrande's public statements have tried to assure investors the company is completing and delivering apartments to customers, but demand is drying up for the developer's future projects. Evergrande has struggled to make progress on asset sales to raise cash, even after its founder put stakes in once prized assets, such as his electric vehicle and bottled water businesses, on sale. The developer in October scrapped talks to sell a controlling stake in its property management business, which could have generated around $2.6 billion. And plans to offload its Hong Kong headquarters have also stalled. News of the demolition order helped trigger a slump on Monday in other developer stocks, which rallied on Tuesday. And a crowd of roughly 100 people protested outside the developer's office on Tuesday, shouting, "Evergrande, return our money," according to Reuters. The reported protests came after the company announced it would dial back payment plans on billions of dollars of overdue wealth management products. Evergrande's troubles have raised concerns about the health of China's massive real estate industry overall. Chinese authorities have called the company a unique case. Analysts, though, have pointed out that in contrast with other developers, Evergrande made little progress towards complying with new regulations aimed at restricting the industry's reliance on debt. But elsewhere, some holders of FXI Group Holdings Limited, dollar bonds, said they've yet to receive interest payments due last week after the Chinese developer defaulted on other obligations in December. And another prominent Chinese developer that met government requirements on debt has also warned of falling sales. Shanghai Shimu told investors in late December it would be difficult to hit its full-year contracted sales targets of 38 billion yuan, since sales in the first 11 months of the year were 28.2 billion yuan, according to a filing. In addition to stock declines, the company's bonds have plunged in the last few months. And more broadly, Chinese shares had their worst start to the new year since 2019, as investors took profits on some of their most successful bets in 2021. The benchmark CSI 300 index closed down 0.5% on Tuesday, marking its weakest opening session in 3 years, and led by declines in renewable energy and healthcare firms. Among the top losers, drug maker Isochem Laboratories fell by 10%. That's the daily trading limit, while Trina Solar slumped 8.5%. And the Nasdaq-style Chinex in Shanghai finished the day 2.2% lower, weighed by battery maker Contemporary Amperex Technology, down 3.3%. The losses came after Beijing said it will terminate the government's subsidy policy on new energy vehicle purchases from 2023. Investor mood also turned cautious after China's central bank cut its net supply of funds to markets by the most in 3 months, a disappointment for investors hoping for more monetary easing. There looks to be more of the same thing that happened last year, with institutional money moving out of the hottest stocks because the positives have been largely priced in, said Gao Shang, Chief Investment Officer at Shanghai University Wisdom Fund. This time it's renewables and EV shares that are most apparent. CATL was the most held firm by institutional investors towards the end of last year, while 7 of the top 10 gainers on the CSI 300 in 2021 were linked to the renewable energy sector. Trina Solar was among them, delivering a 241% gain. In Hong Kong, the Hang Seng Tech Index shed as much as 1.6% after Beijing asked the nation's large-sized tech firms to apply for security checks before seeking overseas stock listings. Mainland investors sold a net 1.57 billion Hong Kong dollars, or about $246 million worth of Hong Kong stocks on Tuesday via trading links, while offshore investors bought 460 million yuan worth of onshore stocks. Chinese stocks, hobbled by regulatory pressures and uneven economic growth, plummeted in 2021. The FXI China Large Cap ETF fell 21% in its worst year since 2008. So, of course, the question is where to from here? Many investors are still seeing long-term opportunity, as China is going to continue to be a big part of the global infrastructure. So the question is, will investors be prepared to wait out the near-term turbulence? Will they stick with China? And what will the broader consequences be in terms of global trade, commodities, and funding flows? This has black swan written all over it. Chinese stocks are generally out of favour, and there is always the risk of catching a falling knife, as they could decline further wrote Jimmy Chang, Chief Investment Officer at Rockefeller Global Family Office. However, I think one can start accumulating stocks of the leading companies if one has a multi-month horizon for a tradable rally. China's crackdown on internet and other companies this year drove Chinese companies' shares down by double digits. But Chang lists the following reasons for a temporary rebound. Sentiment is very negative, and year-end 2021 tax loss selling would be done once the calendar turns to 2022. Fundamentally, the Chinese government will need to stabilise the economy to avoid social issues, and Chairman Xi Jinping is vying for an unprecedented third term, which is to be ratified at the party congress in late 2022. I think he would prefer to prop up the economy to avoid being challenged by other competing factions in the party. And President Biden may roll back some of the tariffs, which could temporarily de-escalate the tensions. Chang warns that companies and investors in the Chinese stocks will be subject to the evolving policy of the Chinese Communist Party, which could become more hardline. They're doing some things around the edges to soften the blow to their economy from the measures they took, said Samir Shamar, senior global market strategist at Wells Fargo Investment Institute. We would be a little cautious. We think in some ways they really kind of mean it this time when they say they're not going to come in guns blazing with stimulus. We do not rule out a bounce, but we don't think it's sustainable. We downgraded emerging market equities, and China is the biggest weighting. Salmon has said the government's more populist turn mean companies will continue to be at risk, as China's leadership this past year emphasised a more common prosperity. It reined in internet companies, education companies and offshore IPOs, and banned cryptocurrencies. When you kind of switch to the more popular side of things, especially when you have a system like China, where they can dictate things, it tends to be more individual or worker-friendly and less corporation-friendly, and that comes at the expense of shareholders who have already felt a lot of pain this year. Ethan Harris, global head of economics research at Bank of America Merrill Lynch, said investors have to look at China differently from the way they had in the past. The Chinese economy itself is likely to pick up as they do some more easing measures, but we think the economy in China is going to be much weaker than many forecasters think. Xi is reasserting China's Communist Party control of the economy, said Harris. We have China growth the same as the US next year at 4%, which is a great number for the US and a disappointment for China. And Harris said China could be in a permanent process of downshifting its growth rate after relying on private sector growth. This is the first time in my experience China isn't following the standard playbook, where they pour stimulus on the economy, he said. This time they've been sitting on their hands. Clearly something is different here. They're changing their priorities. It's no longer growth at all costs. Rising inflation, the supply chain crisis, and China's continued zero COVID approach is among risk factors for Asian markets that analysts are watching. And Morgan Stanley said in its 2022 Outlook report that it remains cautious on both emerging markets and China stocks as it looks for a clearer signal on Chinese stimulus policies, as well as the trajectory of monetary policy tightening globally. And the emergence of the Omicron COVID variant has also increased uncertainty, while inflation will edge higher, Japanese bank Nomura noted. Stocks could pull back between 5 and 10% as markets weigh the inflationary pressure and monetary tightening, said East Spring Investments. The emerging market view is anchored less on the emerging market reopening trade, given China's continued pursuit of a zero COVID policy, it wrote. Investors in the year ahead will also be keeping an eye on Chinese stocks, given the volatility of this corner of the market in 2021. Within emerging markets, we expect pockets of attractive opportunities to dominate, and one which we're watching closely is China tech versus US tech, given the challenges the sector has faced in the past 6 to 9 months, said East Spring. So you can see when you put all of these factors together that the Evergrande story is a microcosm of a bigger story, which is the China economic story. And of course the main question ahead is to what extent the Communist Party there will continue its policies, and if they do, what is the potential fallout? This, as I said earlier on, has the hallmarks of a black swan, or indeed multiple black swans. So caution, I think, is the watchword. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.